How to determine the fair price of an asset. When investing or trading the financial markets, it is important to determine where the price of an asset, such as stocks, cryptocurrencies, commodities, or precious metals, is in relation to its fair price. There are three main analysis methods used to determine fair price: fundamental analysis, technical analysis, and sentiment analysis. In this video, we will look at the basics of fundamental analysis and how you can use it to your advantage. What is fundamental analysis? Fundamental analysis is a method of measuring an asset's intrinsic value by examining related economic and financial factors. Fundamental analysts study anything that can affect the security's value, from macroeconomic factors such as the state of the economy and industry conditions, to microeconomic factors like financial metrics including revenue and turnover of companies. The end goal is to arrive at a number that lets the analyst determine whether the price of an asset is over or undervalued. On a macro level, traders usually look at economic indicators such as the gross domestic product, unemployment rates, or inflation to determine if the state of a country's economy is in good or bad shape. A possible long-term trading strategy here is, for example, to buy the currency of a country that currently has good economic indicators and sell the currency of a country with poor ones. If you, for example, think that the economy of the Eurozone will perform better than the economy of the United States, you could buy euros for United States dollars. On a micro level, market participants may look at the balance sheets of companies to try to determine whether the intrinsic value of a company differs significantly from the price the company is currently trading for on the stock market. If you find the intrinsic value of Tesla is currently trading at $2,000 USD, but the stock is trading at USD $1,100, you would use the findings of your analysis as a clear buy signal for the stock. Large deviations in economic numbers versus market expectation can result in huge price swings when these numbers are released. Dates on which important economic information is released should be treated with caution, such as the U.S. unemployment report, which is usually released on every first Friday of the month, whereas stock earnings reports are generally released in the last quarter. Even though volatility is something traders look for, too large of a price swing either way can also result in large losses. So next time you see an important economic indicator is due to be released, why not take the time and see how the market is reacting after its release? That way you can quickly figure out which indicators are important to watch when trading the asset class of your choice.